Alright, this is Lecture 8. It's on risk and return. This corresponds with Chapter 8 out of your textbook. I want to start by apologizing. It's a little late in the week for me to be getting this lecture up. I would like to get them up on Monday of each week, which I did get up my Lecture 7 this week on Monday, but sorry, this one's a little late in the week. I've noticed the quiz for Chapter 7, not many have been turned in, and there aren't even that many views on my lecture number 7 yet, so I don't think it's a problem for most of the class that I'm a little late in the week. And keep in mind you still have almost a full week to complete your quizzes. They're not due till next Wednesday, so we'll try to get back on a week-by-week schedule. We got off on the first week, and it's kind of just carried over, but keep in mind next week is our first exam. It'll probably be on Thursday. I'll send out details on the exam later this week. So you'll want to make sure you don't have to wait till next Wednesday to turn your quizzes in. You might want to get them done early so you have extra time to study for the exam. There'll also be some lecture material put up next week, Chapter 9 on stocks. I wouldn't expect you to watch that until after your exam because you're going to want to be studying for your exam. So I'll make sure to leave you extra time the next week to get those assignments in for Chapter 9. So for starters, let's look at the basic relationship between risk and return. It's pretty simple. If you want to get more return, you usually have to take more risk. It's that simple. If you want to get less risk, you usually have to take less return. Okay. The easiest way to see this is through an example. So I'm going to switch over to a spreadsheet here. So this is a little example I set up just to show how if you take more risk, you get more return. What I have here is U.S. stock market returns since the late 70s. So it's about 40 years worth of data. We could go further back if we wanted, but it's harder to read the graph the more data you have in there. So I thought 40 years was about a good medium. So the blue line actually represents the stock market return if you weren't levered at all. Levered means you can borrow money to leverage up, which is, let's say, like right here I have 2 written into my little leverage input into my Excel spreadsheet. What that means is for every $1 I'm putting into the market, I'm also borrowing $1 and putting it into the market. So I'm investing twice as much as I put in. It's called leverage. You leverage up your returns, you're going to get higher returns, but you're going to take more risk. This is called basic financial risk or leverage risk. It's a really easy way to see that if you take more risk, you get more return. But if you want to get more return, you have to take more risk. So there's the trade-off. Okay, so here I have 2 put in for the leverage ratio. The red line is my levered up return. Note that over the course of that 40 years, you would have earned quite a bit more. This is a logarithmic scale, so this tells you the percentage gain you'd have made over that time period. So if you take the blue line, you'd have a little bit more, maybe a little bit more than 3.5 times tripled your money, or tripled your money plus a little bit more. If you take the red line, it'd be closer to multiplying your money 6 times, so quite a bit better. So it's great that if you can invest for a 40-year period that you can take leverage, but you got to consider what happens when the market goes down. In the U.S., we had a big market downturn in the early 2000s. We obviously had a very big market downturn in 2008. This line only falls about 50%. This line falls about 100%. Same thing here and here. So you're going to lose more in a bad market. You're going to gain more in a good market. It's not that complicated. There's actually 2 factors that go into this red line. One is our leverage. So we're investing more than we put in. The other is our borrowing. I've included a borrowing cost in here, a short-term borrowing rate. We don't need to get into where I got that from, but it's a short-term borrowing rate I took from the St. Louis Federal Reserve. With the red line, you're leveraging up, but you're also paying an interest rate on the money you borrowed. So you get a higher long-run expected return, but you get bigger swings. It's that simple. Over here, I've turned it into some real simple metrics, which is your average return if you're levered up versus your standard deviation of returns. I would hope at some point you've had a statistics class where you know what a probability distribution is, like a normal distribution. If you have a wider distribution, that's more risk. So you can see where I'm doing with my mouse here. You'd have more in the tails and you'd have less in the middle. If you take that kind of distribution, you would expect to get compensated for it and get a higher expected return. If you take a skinnier distribution, you'd expect to, you don't have as much risk, you'd expect to get less return for it. And that's basically what this is, with what's going on here. If you look here, I've just calculated the average and the standard deviation. That's like what we call the first two moments of the distribution. The average is the middle of the distribution. It's where it's centered at. The standard deviation tells you how wide or skinny it is. Okay, so the average is going to tell you in the long run what you're going to earn. The standard deviation is going to tell you, well, in any given day, how far off of that average is it going to be. So blue column is your non-levered return. So that's what the actual stock market returned if you just put $1 in and it was your own $1 and you didn't borrow anything. But if you lever up 2 times so that you put $1 in of your own and you borrow $1, your average return goes up, but your standard deviation goes up, which means the spread of that distribution gets quite a bit wider. There's a trade-off there. So if I change this to 3, it gets even worse. If I change it to 4, it gets even worse. You can go over and look, if I scroll back here, that the same change is happening to your returns, right? So let me put 2 back in here where we started. Obviously, if I put 1 in here, the lines are the same. No leverage. Leverage ratio of 1 means just 1 to 1. You put the same amount in that you invested. You didn't borrow anything. But if I increase it to 2, the red line, the blue line again is our base case. That's no leverage. The red line gets more volatile, which means over the long run you make more, but in any given day you could lose more. If I go to 3, it gets even more volatile. You make more over the long run, but you could lose a lot in the short run. 4, even worse, and so forth. You can do that before a whole bunch of different leverage ratios, and then you can make this graph right here, which I made earlier. This graph shows the trade-off between risk and return that you could have earned over those 40-year period, that 40-year period. On the x-axis, I have standard deviation. On the y-axis, I have average return. So we're looking at these same 2 variables here, average and standard deviation. But what I've done is I've varied our leverage and seen what happens if I take on more standard deviation, how much more return do I get? If I take on less standard deviation, how much less return do I get? I've done this a whole bunch of different leverage ratios and then graphed it on a line, basically. The star here represents what the market actually did over that period, meaning the actual standard deviation over that period was about 15%, and you got a return of about 10%. But had you levered down or up, you don't have to lever up. You can lever up, but you can also lever down, which means you take less risk. Which means instead of just investing your whole $1 in the market, maybe you invest half your dollar in the market and half your dollar in the risk-free asset, which we usually think is something like treasury bills or government-issued short-term debt. Well, you can end up getting less return, but you get less standard deviation, which is, it depends on how much risk you want to take. So this whole blue line represents the investment possibility in the stock market over that time period. This happened to be what the market actually returned, but depending on how much leverage you took, you could have got anywhere on this line. If you wanted to be more risky, you could have been up here. If you wanted to be less risky, you could have been down here. You can actually extend this blue line to the left if you short the stock market, meaning you bet the stock market's going to go down. It's taking on leverage and removing leverage and even shorting stocks is actually not that difficult if you're a sophisticated trader. You can use futures, you can go long in futures, short in futures, and you can and things like that, to where it's really easy to move along this line. We have fairly sophisticated derivative markets that allow that to happen. So they keep wanting to take out of this is basically the risk-return trade-off that existed in the market over that time period. Let's say you actually invested in something and you got a return that landed right here. So it's above the blue line. That means you beat the market. It means for that amount of risk, which would have been, in this case, 30% standard deviation, you should have been getting a 15% return. But you actually got something closer to 20%. That means you got more return per the amount of risk you were taking. If you were to invest in something and come down here, below the blue line, that means you lost. That means per 30% risk standard deviation, you only got a 10% return. You should have been getting closer to 15%. So the actual return on the stock market isn't the whole story. You have to consider the fact that if I had taken more or less risk. And then you end up with a line. You end up with a linear relationship that shows the difference between risk or return. Alright, if I go back to my outline here, we've done the definition and the example, and we've looked at measures of risk we haven't really looked at yet, but we have, because we saw an average and a standard deviation. That's called a measure of standalone risk. A single investment, if we want to measure its risk and return, we can measure its return by its average returns, and we can measure its risk by its standard deviation. That tells you the spread of its returns. You can get more complicated than that if you want. You can go out and measure the skewness of returns, how much is in the left tail, what probability is there of a large negative event where I lose a lot of money. You can do all that, but this is, anytime you have a mathematical model, you're trying to simplify reality, and these are nice simplifications of reality. You have one number for returns, one number for risk. The number for returns is your average return. Your number for risk is your standard deviation of returns. If I go back to my spreadsheet, I want to show you how to do that real quick. I have a second spreadsheet here where I have returns on the U.S. stock market since late 70s, like I had in the prior one. So real quick, if I make a graph out of this, I'm going to go up and click Insert and do a line graph. It looks like this. This is the dollar value, so it's not in a logarithmic scale, so it's going to grow exponentially. One way to fix that is to make it grow. You can click on here and put a logarithmic scale in here. And change my scales a little bit. Learning how to use Excel, it's a fantastic resource. It's a good idea to play around with Excel. But this shows you what the stock market did over the last 40 years. Now I'm going to go ahead and delete that. That's just to show you a line chart so you have an idea what we're looking at. Now I'm going to show you how to make how to find the average and the standard deviation of the returns of that stock chart. So these are dollar changes. What we want to do is convert them into returns. So I'm going to make a column here. I'm going to call it returns. And there's different types of returns. I didn't cover compounding a whole lot in this class because it's kind of a minute subject that in practice you're not going to have to worry about that much, I don't think. But one thing you could do is you say it equals, and then you do the change in the price in a given day. So I've put in parentheses here B3 minus B2. That's this number minus this number. That's how much extra dollars you gained by owning this stock. And then you could divide it by the original price of the stock. But when you're doing math problems, heavy math, finance, it's easier to work with continuously compounded returns. So I'm going to do the natural log of this divided by this. And I don't want to get into all the math behind that, especially because I'm almost out of time here. But if I click that and copy it down, that gives me my daily returns. Then, to get an average and a standard deviation, there's functions for both of those. I hit equals average, I I select this row or this column, hit equals, or I hit equals standard div